Welcome to Kalkine. Today, we're diving deep into the concept of solvency, shedding light on its definition and significance within solvency ratios. So, what is solvency? Solvency, indicative of a company's capability to repay its long-term debts, is pivotal in gauging its financial robustness and operational continuity. Shareholders' equity, derived from subtracting liabilities from assets on the balance sheet, serves as a fundamental metric for solvency assessment. By scrutinizing shareholders' equity, one can promptly ascertain the company's ability to manage its financial obligations and sustain operations over the foreseeable future. How does solvency work? Solvency illustrates the ability of a business, or individual, to pay off its financial obligations. Therefore, the quickest assessment of a company's solvency involves subtracting liabilities from assets, resulting in its shareholders' equity. Additionally, solvency ratios can shed light on specific areas of solvency for deeper analysis. Numerous companies experience negative shareholders' equity, indicating potential insolvency. This situation suggests a lack of book value, posing risks of personal losses for small business proprietors, unless safeguarded by limited liability terms upon closure. Essentially, immediate shutdown would necessitate liquidating all assets and settling all liabilities, leaving shareholders' equity as the sole remaining value. It's typical for newly developing private companies, startups, or recently offered public companies to carry negative shareholders' equity on the balance sheet. However, as a company matures, its solvency position generally strengthens. Despite being well established, certain events can heighten solvency risks for companies. For instance, the imminent expiration of a patent can expose them to risk as competitors gain the ability to produce the product, leading to loss of associated royalty payments. Additionally, regulatory changes affecting a company's ability to conduct business can pose significant risks. Moreover, both businesses and individuals may face solvency challenges if a substantial judgment is ruled against them following a lawsuit. When you look at how well a company can pay its debts, it's important to also think about how easily it can access cash. Even if a company can't cover all its debts, it might still have money coming in regularly and enough cash on hand to keep things running smoothly. Special considerations. Understanding solvency ratios. The fastest way to check if a company can pay its debts is by subtracting what it owes from what it owns. Another method is using the solvency ratio, which looks at the company's net income plus depreciation and amortization divided by its total liabilities. This gives a good starting point for solvency analysis. Other ratios can give a deeper look into solvency. The interest coverage ratio compares a company's operating income to its interest expense, showing how well it can cover its interest payments. A higher ratio means better solvency. The debt-to-assets ratio compares a company's debt to the value of its assets, giving insight into its capital structure and solvency health. Other ratios that are important for analyzing solvency include debt to equity, debt to capital, debt to tangible net worth, total liabilities to equity, total assets to equity, debt to EBITDA. Solvency ratios differ across industries, making it crucial to know the acceptable range for a company before interpreting its ratio. Ratios indicating lower solvency than the industry average might signal potential financial issues ahead or warrant further investigation. Solvency versus liquidity. Solvency reflects a company's capability to fulfill all financial obligations, typically the total of its liabilities. Conversely, liquidity denotes a company's capacity to meet short-term obligations. Hence, it becomes crucial to assess a company's liquidity, especially if it holds a negative book value. A quick way to check liquidity is by subtracting short-term liabilities from short-term assets, also known as working capital. This shows how much money a company has available to pay upcoming bills. Short-term assets and liabilities, like cash and accounts payable, typically relate to a one-year timeframe. While a company can endure with insolvency for a while, it cannot function without liquidity. Some useful ratios for delving deeper into liquidity include quick ratio, current ratio, working capital turnover. How is solvency assessed? Calculating a company's solvency ratio can be done in various ways, but a fundamental method is to subtract its liabilities from its assets. If there's value remaining after deducting liabilities, the company is deemed solvent. Are solvency ratios consistent across all companies? Solvency ratios differ across industries. While companies aim for more assets than liabilities, the acceptable surplus can vary based on their sector and operations. Is it possible for a company to survive if it is insolvent? Certain companies can function despite being insolvent for a period. Because assets and liabilities are often long-term measures, they might continue operations similarly to solvent firms if they possess liquidity. Liquidity refers to the capital a company has available for its business operations. Hope you found the video helpful. For more content like this, make sure to subscribe to the channel and hit the bell icon.